Good afternoon, ladies and gentlemen. My name is William H. Thompson, CPA, MBA, and I am the founder of RE Accounting and Tax Professionals. We help real estate investors maximize the return on investment through expert tax strategies, while at the same time helping them to build and sustain a legacy. Welcome to Free Information Friday. Today I'm going to discuss short-term rentals and the personal use of those short-term rentals. Now, we all know we tend to buy our short-term rentals in areas that we ourselves like to vacation, and there's nothing wrong with that. But it's important that you don't break the personal use day rules, because if you do, it could trip up your tax benefits. So let's start with how many days can I actually stay in my property? Number one, you can stay in your property 14 days or less without tripping the personal use rules. Or you can stay in your property 10% of the days that it's actually rented. Now that's 10% of the days actually rented, not 10% of the days that it's actually available for rent. So for example, if you rent your property for 200 days, 10% of that is 20 days. So you can stay in your property the greater of 20 days or 14 days without tripping the personal use rules. And that's important, because if you do trip the personal use rules, you're going to run into an issue with your tax benefits. And I'll discuss that in a second. So let's say that you do stay in your property 14 days or less. You're still going to have to prorate some of your variable cost. For example, let's say that you in fact stayed in your property 20 days and it was actually rented for 200 days. You're going to have to allocate 10% of an electric bill to personal use. Example, let's say that your electric bill for the year was $3,600. 10% of that, $360, is going to be stripped away from you. So the total expense that you're going to have is $3,600 minus the $360, which is $3,240. That'll be the actual expense to your short-term rental. However, the most important thing is, if you do trip up those rules and you stay more than you're allowed to, you're going to reduce your tax benefits. And now let me give you an example. Let's say that you cost segregated your short-term rental and you came up with $150,000 of bonus depreciation. But you only had a $10,000 profit before depreciation and proration on the short-term rental. You can only deduct $10,000 from that $150,000 of bonus depreciation to reduce your income to zero. You can't bring it below zero and show a loss. And that's because you violated the personal use rules. Now you do not lose that $140,000 of loss that's remaining. It will apply in future years, but it will still be capped at the amount of income that you had, because it was classified in such a way because you broke the personal use rules days. So it's extremely important that you're aware of these rules so that you do not break them, so that you do not run into these complications that I just mentioned. Now, another thing I want to bring to light. Let's say that you're in a partnership. You might think that each partner is available to get 14 days or 10% of the days rented. Not true. It's aggregated at the partnership level. So if you and your partner each stood 10 days in that rental, in your short-term rental, you better hope that you had rented it out at least 200 days. Because if not, you're going to be caught violating the personal use days rule, which, as I mentioned before, is going to limit your deductibility from your expenses. So I hope this segment of Free Information Friday was helpful. And if you got anything out of it, please know that it's important not to trip the personal use rules. Otherwise, it's going to leave you in a spot you don't want to be in. In conclusion, if you're a real estate investor who wants to maximize return on investment through expert tax strategies, book a call with our firm. And remember, only you can create your empire, but we are here to help every step of the way. Thank you, and I wish you much success on your real estate journey.